All right, everybody, welcome to the session. Welcome to today's live trading session. Guys, if you can hear me, please let me know in the chat. If you can hear me, let me know in the chat, guys. If you can hear me, let me know in the chat. Welcome to the session, everybody. If you can hear, I can look at the chat to see. I can hear myself. All right, guys, welcome to today's session. We're going to go first. I'm going to start with the economic calendar. You guys know that we always have to do that to check what's going on in the world before we go to the charts. But I believe you guys can hear me. I can just play the feedback and I can hear myself. Welcome to the session. Today was good. We had GDP from UK and then we had PPI from US as well. Let's just okay. I'm going to start with the economic calendar first. All right, guys, if you can hear me, let me know in the comments. How has trading been this week? It's Thursday. Tomorrow is going to be the end of trading currency pairs, and then you can trade digital currencies over the weekend. But how has trading been this week? We had CPI and now PPI. Obviously, volatile economic events that will bring about volatility to the markets. How has trading been? Let me know in the chat. Let me know in the chat. We have GDP month over month, so I had to filter to only the high impact events first, just so that we can focus on the most important events. So I had to filter to high impact events. And first, we're going to talk about the GBP GDP, so the UK GDP, right? Month over month. If you don't know what this is, you can read here. I'll still go ahead and explain for you guys what it means. But we're going to start with the first major report that we had today. And before I go ahead to talk to you guys about the numbers that we're seeing on the screen, which is 0.3, I'm going to first explain to you guys what GDP means. So GDP means gross domestic product, and it's one of the broadest ways that we measure the amount of economic activity that is taking place in a country, right? So if businesses are producing more, consumers are spending more, restaurants are serving more customers, factories are, creating more products, all these things would increase economic output. And when all of that economic activity is combined, then you get GDP. So you can call the GDP, or you can think of it as something that is similar to the scoreboard of an economy, right? It doesn't tell you everything about the economy, but it gives you a very good idea of whether economic activity is expanding or it's contracting. Now, this is where I'm going to connect, and I want you guys as well to connect economics to trading, right? Currencies represent economics, right? Currencies in itself represent economies. So if you buy GBP USD, you're not just buying a chart, you're comparing two economies, the United Kingdom against the United States. And an investor would constantly ask which economy is stronger, which central bank is likely to maintain the higher interest rates, where can capital potentially earn better return. That's why economic growth matters, because the stronger economy can make a currency more attractive. A weak economy can make a currency less attractive. But the most important word in what I just said now is can. That's the most important word. GDP doesn't automatically mean, the GBP would go up or down just because of the results. You still need to consider some other things: inflation, interest rates, expectation, and what is happening in other currencies. But we'll come back to that. Today, we're going to look at the UK GDP, right? The previous is at 0.0, the forecast 0.0 as well, and the actual 0.3 positive. And I want you guys to notice something. The market was not expecting growth, right? Economists expected the UK economy to essentially go nowhere during June, 0.0. But what happened? The economy expanded by 0.3. So this basically means that the monthly GDP in itself grew by 0.3% in June, after it had no growth in May. So what does this mean, and why is this figure important for you as a trader? Sometimes you see 0.3% and you just think, oh, it's tiny. But you have to remember, we're talking about the change in output of an entire national economy in one growth. You see the number and say it's small. You don't need the GDP to increase by 10% in a month for the number to be important. What matters to you as a trader is the difference between what just happened and what was expected to happen. The expectation was 0.0, the reality is positive 0.3, and that's the surprise. And that's what we trade in this market. We trade surprises. Let's say you own a company, right? You have a company that you own, and as an investor, or your investors, expect your business to make exactly the same amount of money this month as last month, right? So they didn't expect any growth. They didn't, just the same thing. And then you publish your results and you've actually grown. Your investors are going to view that as positive, right? Not because the growth is big, but you outperform their expectations. And that's how the financial market operates. The market has already prepared itself for 0.0%, no growth, and then it received 0.3%. So investors would now have to adjust their expectations. And you'll be wondering, where did this growth come from? And that's where the report becomes very interesting. What the headline tells you is GDP increased by 0.3%, but as an analyst, you don't just stop at the headline. You go ahead to ask the question, why? Why did it increase by 0.3%? Now, the Office for National Statistics reported that the UK services sector grew 0.4% in June, which helped drive the monthly expansion. Production and construction fell by 0.2%. These services dominate the British economy. The banking, insurance, retail, hospitality, professional services, healthcare, transportation, communication, all of these things form part of the services economy. So the largest part of the UK economy performed relatively well. We're going to move to the next one, which is the core PPI month of a month. But if you guys have any questions concerning the GDP, let me know in the chat. Basically, if you want to understand, how this affects your trading, you just have to connect the reports you're seeing here to the Bank of England, right? For the GDP. You connect it to monetary policy. Remember our previous sessions where I told you guys that the central banks generally become more concerned about cutting interest rates when an economy is already weak. Because when you increase the interest rates, borrowing will become more expensive. Business will borrow less, consumers will borrow less, mortgages will become more expensive, investments can slow. High interest rates make borrowing more expensive. So imagine the economy was already contracting badly. The Bank of England might just say, oh, we need to provide more support, But today, GDP number tells the bank the economy is holding up better than expected. And this would give the Bank of England a little more room to remain patient. So the stronger the growth, the lesser the urgency for monetary policies, aggressive monetary policies, and that's generally supportive for the British pound. So is today's GDP bullish or bearish for GBP? Fundamentally, today's GDP surprise is bullish for the pound. Actual is way higher than previous and way higher than expected. Yeah, 0.0, but came out at 0.3. But you have to understand that GBP doesn't trade in isolation. If you're trading GBP, you have GBP on one side, you have USD on the other side. And that's where the core PPI comes into play. So you have to ask yourself, was today's US data stronger or weaker than the UK data? Let me know if you guys have any questions. Okay, so core PPI month over month, the forecast was at 0.3, the actual 0.2, and then PPI month over month forecast 0.2, actual 0.0. First, I'll still explain what PPI means for you guys. It's closely related to CPI, but I'll explain to you guys. This is from the producer perspective. CPI is from the consumer perspective. Let me see if you guys have questions before I proceed. Okay. All right. Now, this time we're not going to be talking about economic growth. We're talking about inflation. And these are two major US reports, PPI and core PPI month on month. Now, if you're new to trading, when you see PPI, CPI, you just assume that, oh, okay, PPI and CPI is just a 3-letter abbreviation that I have to memorize. But it's not always about memorizing it and, just knowing when it's going to come out. It's also good that you understand it, because once you understand the idea behind it, you understand why something as simple as 0.2% can suddenly move the dollar, move gold, move NASDAQ, move treasury yields, and all that. So PPI stands for Producer Price Index. The key word there is producer. PPI measures the changes in prices that producers receive for goods and services. That's basically what it does. It's just like you're measuring price changes from the seller's perspective. Imagine you walk into a supermarket and you buy, let's say, a bottle of orange for $5. From the customer's perspective, $5 is the final price, right? But that orange didn't just magically appear inside the supermarket. Let me see, can you guys still hear me? Okay, yeah, you guys can hear me. As I was saying, the orange didn't just magically appear inside the supermarket, right? Before it got there, someone grew the oranges, someone processed them, someone manufactured the bottle, someone packaged, the juice, someone transported it, everything, distributed it, and eventually the supermarket sold it to you. So before consumers experience prices, businesses and producers are already experiencing prices throughout the economy, and that's why PPI is important. PPI also gives you another perspective into inflation. If you own a restaurant and your restaurant spends, let's say, $10,000 every month buying ingredients, foodstuffs, and then suddenly the same thing you buy with $10,000, you start buying it with like $13,000. If you're the owner of the restaurant, you have a problem, because it's that you accept lower profits, you reduce costs somewhere else, or you just increase your menu prices. I don't know if you guys can still hear me. Is this from my end? What's going on? Okay. And what happens if a lot of businesses across the economy starts doing the same thing? Eventually, all the consumers will start paying high prices too. That's why economists pay attention to producer inflation. So we're going to look at the numbers now. The PPI previous, the month over month, the core PPI month over month, came out let's start with the PPI, the normal PPI, right? The actual was 0.0. The last time this was released, it came out at 0.2%. So what it basically means is that the economist expected producer prices to rise by 0.2%. Instead, it was 0.0. So was that higher or lower than expectations? It was lower. And that's the first important piece of today's story. Again, you see 0.2% and you wonder, is it really important? Is it not small? Is it not tiny? Remember what we've discussed about economic calendars. Markets don't trade numbers. Markets trade the difference between expectations and reality. That is it. If you tell your investors, if you have a company and you tell your investors, oh, we're going to make $100 million this quarter, and the earnings come out and you're making 80 million. 80 million is still a lot of money, but that's not the point. The company promised $100 million. So the surprise is what matters. And that's the same principle here. 0.2% was the expectation, but you received 0.0%. So producer inflation was softer than what the economists expected. So what's going on with the... Okay. I thought I just saw a glitch for a few seconds. And then we have core PPI. So what is core PPI and why do economists create core inflation measures? Now, you have to understand that some prices are extremely volatile. For example, energy. Oil can suddenly rise because of geopolitical tensions. The prices of gas gasoline can just fall sharply. Food prices can change because of just weather conditions or, climate. All these movements can distort the underlying inflation picture. So traders look at core measures to ask, okay, what if we strip away some of that volatility? What is happening under it? And that's where you get the core PPI. So the core PPI previously was 0.4%, forecast 0.3%, and then the actual 0.2%. Again, look at the surprise. Economists expected 0.3, actual came out at 0.2. So this rose less than expected. It's still 0.2, it's higher than 0.0, but the forecast was 0.3. So the headline PPI surprised lower, the core PPI surprised lower as well. Now, we have two pieces of information that is pointing in the same direction. If you take away all the numbers and you start analyzing what you're seeing here, it tells you one thing. Headline PPI, softer than expected. Core PPI, softer than expected as well. So producer price pressures were weaker than economists expected in July. It doesn't mean that inflation is finished or the Federal Reserve will cut rates or you should go and sell the dollar. No, it just tells you that today's producer inflation readings were softer than the market had anticipated. Let me know in the comments if you guys got that. So is this report bullish or bearish for the dollar? That's the trading question. Everything else being equal, today's PPI package leans towards a bearish dollar because both the headline and core PPI came in below the forecast. So it leans bearish. I didn't say the dollar is going to fall, but it leans us to the bearish side. What the economic data does and this economic events does is it gives us information, and then the market is going to decide how important that information is. So generally, this report is supportive for gold. It supports the gold bullish move. And why I say that is because here's my logic behind it. Softer inflation leads to less pressure for tight Fed policy, and that's also going to lead to a potentially lower rate or yield expectations, which is also going to lead to a potentially weak dollar, which gives more room and more environment for gold to go up. But we're going to open the chart and I'll show you guys the important levels because, again, PPI this, PPI that doesn't mean go and buy gold. You have to still look at where the market is sitting, identify important areas, and trade accordingly. Let me know if you guys understand. We're going to go to the charts right now. And this is where technical analysis comes in. This is why I don't like the argument, are you a technical trader, are you a fundamental trader? Why do I have to choose? Fundamental tells me what's happening in the economy. You know, fundamentals help me understand where are the institutions, why would institutions actually move money, not where? Why would they want to move money? Technical analysis tell me where are the buyers and sellers responding? How much am I willing to risk if my interpretation is wrong? All these things work together. So we're going to start with GBP. Obviously, my fundamental bias is mildly bullish, and the reason is because we had a stronger than expected UK growth. On the dollar, my fundamental bias is bearish as well. So I'm expecting GBP to go up, but again, we have to identify the levels where we'll be comfortable buying. GBP. Now, if you don't understand what's on my chart, I think I mentioned this in the last session. I have simplified my trading system to identify most of these zones for me, most of these important zones, like the premium, the equilibrium, the discount zones, the structure breaks, all that. So basically, in a trending market, I already know the levels I want to look out for. In a ranging market, I also know the levels I want to look out for. Now, currently, the market is sitting in a fair price, which is the equilibrium. The equilibrium is like a fair price. It's the middle. Okay, this is where decisions are made. This is where decisions are made in terms of this is where the market is going to decide if it's going to come all the way down to the discount zone, which is the cheapest zone, or it's going to continue its rally to the premium zone. And if you notice, we have liquidity resting in all these zones right now. Below here, above here. We have liquidity resting right there. Making decisions at the equilibrium is not really ideal. You have to wait for the market to provide opportunities for you, especially if you're trading against this trend. The trend is obviously bullish, right? You want to first identify the trend and decide which level am I trading in? Am I going to trade in the direction of the market, or am I going to trade against the market? Now, don't get me wrong. Whichever way you choose to trade, in the direction of the market, against the market, you can be profitable. But if you're trading against the market, you have to create that mental awareness that whatever move you're getting can be temporary. I'll give you an example. You can see that this market was bearish from half of July all the way down to the ending of July. And then what happened? Entering August, the trend changed, right? In this trend change, there were pullbacks. Could you have made profits trading against this move? Yes, but because you already identified that we're having engulfing candlesticks here, we're having bullish momentum candlestick creating fair value gaps here, and another bullish momentum candlestick as well. It's just evidence that the buyers are in control. So even if you want to trade against the market, let's say your RSI was overbought and then you wanted to trade this equal high here, right? This rejection here. Just by understanding that we're coming from a bullish impulsive move, knowing fully well that the market is not just going to come all the way up like this and take you down, except there's an impact news, you just know that it's going to be a temporary move. Or if you're trading the bearish move down here, and you already see that this market is creating consecutive lower lows and lower highs, you just know that it's pretty bearish. So even if you want to trade against it, it's going to be temporary. You only identify a reversal when the market has completely reversed. let me give you an example of what a complete reversal would be. So let's say we're coming all the way down here, bearish move, bearish move, bearish move. Now, your first indication of a reversal from bearish to bullish is the market's inability to create a lower low. You can see here, lower low created, lower low created, lower low created. The market didn't have the ability to create any lows beyond this point. And it didn't just struggle. The buyers also showed themselves all the way up to the previous swing high. And we identified the previous swing high. Obviously, the market is going to dance around there. And then what happened? The market also showed you that the buyers are in control of this chart. Obviously, this is not gold. So, and that's one of the things I like about currency pairs. It's not gold. So from here to here will just be about 55 pips, which you've seen the buyers maintain control. I'm not asking you to execute trades on the higher time frames, but if you go to the lower time frames, you obviously find breakouts in that direction that would give you confirmation that the market is about to go all the way to the upside. All right, so a breakout confirmation would be something like this. Obviously, I believe you guys can see. I'm gonna zoom in. It's ideal to execute on the lower time frames in the direction that rhymes with what you're looking at on the higher time frame. So impulsive move, rejection, rejection, rejection. Obviously, this is going to be an area where I'll be looking out for. If I'm going to buy this pair, I need to see the market break out of this point, right? And a sustained break above this point. Two things: I could have chosen to enter early, right, and put my stop loss just below here, which is going to be something like this. This stop loss will be about 39 to 40 pips, which is still cool. I can choose to enter here, or I can choose to wait to see the market tap into this fair value gap here, which is going to align exactly with this zone here, right? I'll put the line for you guys to see. But whichever one I choose to do, enter here, which is going to be this break above this point. The market is going to pull back a bit, or wait for the market to pull back down, add more trades. I would have still been in profit. And why? Because I already understood that the market has signaled a change, and that change was sustained by this breakout and continuous inability for the bears to push this market back down. And that would have been a really good trade. So in the grand scheme of things, the market is still pretty bullish, right? This move is still being sustained. There is no break below the discount level. If you want to identify that this market has changed trajectory, then you need to see a break above here, or below here rather. You need to see a break below the discount. Okay, but as long as the market keeps trading above this point, everything you're looking for is a buy trade. Including here, all these zones are buy zones. This is the equilibrium is also a buy zone because there's liquidity sitting here, which has already been taken out. This zone is also a buy zone as well. And then the discount. So you see how the market reacts at 134.80. You see how the market reacts at 134.50 and how the market reacts at 134.10. Okay, we get bullish momentum from these zones, we're buying. All right, we only turn bearish if we break below. Otherwise, looking for bullish opportunities on GBP. Let me know in the chat if you guys have questions. And then we're going to go to gold, right? I told you guys gold. Gold is moving lower from this bullish structure. The bullish structure has not been broken completely yet, but it's just moving lower. Price action is not giving us a straightforward bullish continuation right now, especially if we break below this point on gold. And guys, you know, one of the important things about trading, especially if you're trading the zones, is patience. I always tell you guys that it's really important. Patience is a skill that every trader must master. I've been preaching this on this channel for how many years now? Patience is a skill that you must master, especially if you're a zone trader. The reason is because when you look at the markets, right now, I don't need to start mapping out all these zones. I already pretty much coded it into the system, so it just maps it out for me by itself. But either way, right, whether you map it out or you have it coded in your trading view, when you come into this market, the zones are identified. Every zone you see here, every fair value gap you see here is bound to be filled. Every liquidity zone you see here is bound to be filled. It may just take time. The reason I'm saying this is because when you identify your zone, you'll be more comfortable executing from that level. You'll be more comfortable executing from the zone than just trading in between, than just trading here or trading in between all these places. You can see that this was the previous daily high, which obviously the market is rejecting from. This is also our current premium zone. This is an equal high with the previous high that was created about 2 days ago, right? And now the market has come to retest it again. These are zones that when you execute trades from these levels, you're more comfortable. And again, you don't need to execute them from the higher time frame. You just need to look at the lower time frames, spot the rejection, another rejection, and you trade accordingly. The same thing here, rejection, you trade. If you see this massive candlestick forming on the higher time frame, it tells you one thing. Most of the time, we see things happen in the market, but we just choose to trade what we feel and expect the market to give us results based on what we feel. But that's not really how markets work. The market works in the exact opposite way. The market doesn't know what you're thinking, doesn't know what you feel, doesn't know if you made a profit yesterday or lost money yesterday. As a matter of fact, the money you're trading has no influence on the market. So it's going to move either ways. And when you understand that, what comes to mind? You're trading, you're riding the wave of the people that actually move this market, the hedge funds, the high institutions, the banks. So if you don't move the market and you're following the trails of the people that do, why are you now hoping for a move? Why are you hoping that the market is going to do something when you don't even move the market? If you had like $2 trillion now, you'll be more confident and say, if I buy gold with, obviously you can't just pump $2 trillion into gold, but if I identify the zones where I want to buy gold and I just pump the money, split the money into bits and I pump it in different areas, you have some kind of confidence because you're controlling $2 trillion. But when you're controlling like 10,000, 100,000, $1 million, it's not going to do anything. Market is not going to move because of your money. So when you're analyzing this market, analyze it from the perspective of someone that is riding the wave of the bigger picture of the people that actually move this market. And by doing that, you identify zones and you trade, you react to what is happening in those zones. If you buy anywhere in the market and you expect the market to go up, you're already setting yourself up for a bad trade. But if you buy because this zone looks good, this zone is the good zone where I'm seeing equal lows, I'm seeing rejections from here. This zone is a good demand zone. This zone is a zone where liquidity is resting, and I'm seeing momentum that is pushing up the price or is breaking the price below. Pretty good. If I'm to analyze gold right now, right? And I'm looking at this market. I don't think the bear move stops here, right? I think it's going to come all the way down. But I'm not going to go ahead and execute a sell because I think it's going to come all the way down. I would want it to close below the previous daily low. This is the previous daily low. What this means is this is the lowest point gold was at yesterday. And it has come back to test it. So you ask yourself, is this a test and retest, or is price going to break through? And the only way to find out is if you actually wait to see what price does. You have FVG sitting here. We have another one sitting here. We have a swing low here. So it's normal to expect this market to pump all the way down. But first, we have to close below the previous daily low. Remember, we couldn't close above the previous daily high. And what happened? We started trading inside of it. So between yesterday and today, the market has done this, right? Market has done this and this. So imagine you were on a buy trade here. That's taking you out. If you're on a sell trade here, that's taking you out. So the market just did this and this, traded in the same range. In 3 days, you can extend it back to this period. So overall structure is bullish, but when you see the markets trade in a range in 3 days, you just know that this bullish momentum is beginning to slow down. Let me give you guys an example of what slowdown means. This is an example of a pullback, right? Just minor retreat. Obviously, if you're running a marathon and you want to run 500 meters, you won't just run it at once. Or people can run 500 meters at once anyway. If you want to run 1,600 meters, you won't just run it at once because you have to go around 4 times, right? Right? Yeah, 4 times, 400 meters. Yeah. So you'd run and slow down a bit, catch your breath, continue, slow down a bit, catch your breath. That's literally what the market is doing. But when you're running and you just slow down for a very long time and you're walking, to the point where you're walking, you're not slowing down again, you're finding it difficult to continue. What does it tell the people watching you? It's about to come back, it's about to slow down, it's about to quit. So whether you quit or not, whether you quit the race and go back to your stand or you continue, people can tell based off what you do on the track. So whether gold wants to go up or continue to come down, you can tell based off what you're seeing with price action. Now, slow down here, slow down here. You see that it's short. We just pull back, we continue, right? Pull back, continue, pull back, continue. But now we've pulled back, we tried to continue, we couldn't break above. We've pulled back again to the previous daily low. This is an important zone for gold right now. Because if this market breaks this point and sustains that break, guys, gold is coming all the way down to 4,318. If gold breaks this point and sustains that break, we're coming all the way down to this point. And when I say all the way down, I'm not saying you should just start selling and it's going to come down at once. No, the market will probably not do that, because if you look here, you see it went down, went up, went down. The same thing for here, went up, went down, went up, went down, went just like that. So, but the destination doesn't change. If we sustain a break below the previous daily low of yesterday, we're coming down. Simple as that. And then you want to go to the lower time frames to look for momentum that's going to take us to that direction. Let me know if you guys have questions. This is my analysis on gold. Just did GBP USD a few minutes ago. But let me know if you guys have any questions. All right. Oh yeah, we're going to talk about the trader you become right after now. And obviously, you can get 100% bonus in your deposit when you use the promo code Ambrose E100. Just follow the step on your screen or the link in bio. Create a trading account, follow the steps, and get access to your bonus. We're going to talk about the trader you become. Just want to see if you guys have any questions. Okay, no questions, right? So before we wrap up, I want to talk to you guys about something that I think every trader eventually has to understand. And I'm going to start with a statement that might sound strange, but it's not. You can do everything right in trading and still lose money. And you can do everything almost wrong and still make money. Now, if you're new to trading, it's going to sound ridiculous, right? Because growing up, you're taught that good decisions should produce good results. You study hard, you expect a good grade. You know, if you work hard, you expect good results. If you train, you're expected to improve, right? So naturally, when people enter trading, they bring the same thinking with them. They think, if my analysis is correct, I should make a profit. And therefore, if I lost, my analysis must have been bad. But trading doesn't work that way, right? And understanding this completely will change the way you evaluate yourself. Now, if I give you a six-sided dice and I tell you, if you roll anything from 1 to 5, I'll give you $100. But if you roll a 6, you lose $50. I'm sure a lot of you guys will take the bet because obviously there's 5 possible winning outcomes. So anything you roll from 1 to 5 gets you $100. But if you get a 6 once, you lose $50, right? It's an incredible opportunity. You only get to lose once. I mean, and then you roll the dice. And unfortunately, your first number was 6. You already lost $50 without even getting your $100. Does it mean taking the bet was a bad decision? No. It was an excellent analysis. I mean, 5 options to make a profit, 1 to lose $50, but the outcome was bad. And that's the difference. Now, if I offer you another chance to utilize the dice and I tell you, okay, if you roll a 6, I'll give you $100. Anything else, you lose $100. You say it's a bad it's the system isn't right, because if you roll a 6, you get $100. If you anything else would give you you would lose $100. I mean, you only get to make a profit once, right? By rolling a 6, there are a lot of options. There's a lot of possibilities that you would not roll a 6 first, but you still go ahead and do it, and you say, okay, fine, it's terrible odds, but let's do it. And then you roll, and somehow you get a 6. You just won $100. Was it a brilliant decision? No, because you had more possibilities of losing the money than making a profit. If I give you a dice, you roll a 6 once, you get $100. If you roll anything that is not a 6, you lose $100. You could have rolled from 1, 2, 3, 4, 5. It was bad, right? But you did it and you got a 6. It wasn't a brilliant decision, but that bad decision gave you a good outcome. And that's how trading works. And this is where some traders get confused. Imagine somebody enters gold and they're like, oh, no stop loss, no analysis, nothing, just risking 50% of their account. And because they just saw that somebody in Telegram said buy and they just bought and then they made $2,000. What does that trader think? Oh, I'm good at this. I'm going to make money. But that's not necessarily the same thing as trading well, because the market is going to reward bad behavior. It doesn't know if you're doing something bad or doing something good. So what are you going to do next time? You go again, you risk $50. You ignore your stop loss, you don't follow proper analysis, and maybe you profit again until one day you just don't. You just lose everything. And now we're going to look at the opposite trader, the one that wakes up, checks the economic calendar, understands PPI, understands gold, the dollar, the DXY, obviously, waits for technical confirmation, risk 1 to maximum 3% of their account, places their stop loss where the trade idea becomes invalid, goes for a 1 to 2 or 1 to 3 risk to reward ratio. Everything is planned. They enter, and something unexpected happens. Maybe price hits their stop loss. Did they trade badly? No, they lost the trade, but they traded well. And that distinction is incredibly important. Trading is a probability business. This is what I constantly tell you. We're not trying to know what happens next. We're trying to identify situations where probability and potential payoff are favorable. There is no strategy that's going to profit every trade. There's no economic report that's going to guarantee a direction in the market. There's no order block that must hold. There's no support level that cannot break. There's no resistance level that cannot be breached. Everything is probability, and that's why risk management exists. Guys, if certainty existed in this market, we would not need stop losses. Think about it. The existence of your stop loss is already an admission that I believe this trade has a good probability of working, but I accept that I could be wrong, and that's mature trading. And everyday life works like this too. The lesson goes beyond trading. Sometimes you make a good decision and something unfortunate happens, something bad just happens, or sometimes you just make a terrible decision and somehow you get away with it. Imagine someone driving home drunk and they arrive safely. Does arriving safely prove that drunk driving was a good decision? No. They experienced a good outcome from a terrible decision. But somebody can drive responsibly, follow every traffic rule, and still get hit by another driver. Bad outcome, responsible decision. That's why intelligent people don't only judge decisions based on what happened afterward. They just ask, given the information I had at the time, was this the sensible decision? That's exactly how I want you to start reviewing your trades. Stop reviewing your trades like you open your journal and you see $400 good trade, $200 loss bad trade. No, that's not enough information. Start asking yourself, did I follow my setup? Was my entry planned? Did I understand economic environment? Did I use proper risk management? Did I place my stop loss logically? Did I follow my rules? Did I interfere with this trade emotionally? Would I take this exact setup again if I was presented with the same information? Now you're actually reviewing your trading. I want you guys to write this down. There are only four types of trade. Four types of trades. Good decision plus winning outcome. Perfect. You followed your process, the market rewarded you. You can write this down. Good decision plus winning outcome. Perfect. And then we have good decision plus losing outcome. Also fine. It's part of trading, right? Good decision, losing outcome. It's cool. Bad decision, losing outcome. That's the third one. And this is useful. The market punished your mistake immediately. So hopefully you get to learn from it. But even as ridiculous as it sounds, the most dangerous one is bad decision, winning outcome. Because now the market has rewarded you for breaking your rules. And you may mistake luck for skill. And that's how dangerous habits are created. Think about what we did today. If you look at the sessions, we analyzed UK GDP, we analyzed PPI, we looked at the information, what it means for GBP, what it means for USD. We built a fundamental narrative and then we went to our charts. Why did we do all that? It doesn't mean doing all that is going to guarantee you consistent profit. But we're trying to improve the quality of the decision. Guys, trading is not just about technical and fundamental. It also has to do with psychology. And as a trader, your job is to control your analysis, your entry, your risk, your preparation, your behavior. You cannot control what the next candle does. And this is where consistency comes from. People say I want to become a consistent trader, but what they really mean is I want to consistently make money every day. That's not the first consistency you should be chasing. The first consistency you should be chasing is to become consistent in your behavior, to become consistent in checking the calendar, managing your risk, waiting for your setup, accepting invalidation, avoiding revenge trading, because you cannot completely control whether today's trade is going to be profitable, but you can control whether today's trade is going to follow your rules. And over a sufficient large sample of your trades, if your strategy has an edge, that's when the numbers begin to matter. So the question I want you to start asking yourself is, don't say, did I make money? No. Ask yourself, I mean, money is important. That's why we're here. But first, ask yourself, did I trade well? Those two questions are not going to have the same answer. Sometimes you trade well and lose. Sometimes you trade terribly and you win. Your job is to make sure the quality of your decisions remains high enough for a long time that your edge has an opportunity to play out. And I'll leave everyone with this tonight because we've come to the end of today's session. I've looked at the chart and I'm not seeing any questions. So I'm going to leave everyone with this. Amateurs judge the trade, professionals judge the process. One winning trade doesn't make you a good trader. One losing trade doesn't make you a bad trader. What matters is what happens when we look at your last 20, your last 50, your last 100 trades. Were you disciplined? Did you manage risk? Did you follow your system? Did you learn from your mistakes? Because ultimately, your goal is not to make every trade profitable. Your goal is to make every trade a good decision. If you can learn to do that consistently, the individual profit and losses become much less important. And that's when you stop trading emotionally. That's when you start thinking like someone who's building a career in the markets. The trader you become will always matter more than the trade you take. So don't let one winning trade make you arrogant. Don't let one losing trade make you doubt everything you've learned. The market is always going to be here tomorrow, next tomorrow. Your responsibility is to make sure your capital and mindset are here tomorrow and the days and months and years after that. All right, guys, thank you for showing up, for asking the questions, for participating in the chat, for being a part of this journey. You can go ahead and ask me anything you want in the chat, and anything about trading. It doesn't have to be today's session alone. You can ask me, and I'll go ahead to answer your questions. All right, everybody. If you don't have any questions or you're watching this after the live has been streamed, you can still ask in the comments. Thank you guys very much for joining, and I will see you next time. Bye, everybody.